All right, let's dive into U 2.0, rewriting your financial future. This book is all about taking control of your finances, especially for those of us in midlife who are ready for a fresh start. And we're going to, instead of just giving like a basic summary, really extract those key insights, those aha moments, and turn them into actionable strategies. So it's like having a financial coach right here, guiding you, through the process. The book starts by really kind of challenging that traditional work till 65, then retire mindset. And it argues that midlife is kind of prime time for a financial reset. You know why? Because you have more earning potential, more financial awareness, more assets to leverage now than you did, say, in your 20s or 30s. You've got that experience on your belt. You've learned from maybe some financial mistakes, and you're probably earning more. So it's time to kind of use all those advantages to really design the lifestyle you truly want. One where work becomes a choice, not an obligation. Now, one of the most interesting things the author, Dr. Abhay Gupta, talks about is this idea of shifting your mindset.
It's about moving away from that scarcity mindset, always worried about saving every penny, to what he calls an abundance mindset. So it's less about, I need to save every penny, and more about, how can I grow my money strategically? How can I take advantage of opportunities that maybe I'm missing out on? Because I'm afraid to take calculated risks. And it's not about becoming reckless. It's really about shifting your perspective from one of limitations to one of possibilities. And this mindset shift is crucial because it lays the groundwork for becoming an active investor, not just a passive saver. And let's face it, saving alone just won't cut it in today's economy. You need your money to work as hard as you do, and that means investing it wisely. So we're talking about things like stocks, real estate, maybe even your own business ventures. But before you jump into investing, you need to take stock of where you are right now. It's like getting a financial checkup. Dr. Gupta talks about 3 key things you need to understand: your net worth, your cash flow, and your debt to investment ratio. So first up, your net worth. This is the true measure of your wealth, not just your income.
And it's basically what you own minus what you owe. So it's like, are you really building wealth, or just a high income that's being eaten up by all those expenses and debt? Tracking your net worth regularly can really help you see the big picture, and will help you pinpoint those areas where you might need to make some changes. Okay, next, cash flow. This is all about what you keep, not just what you earn. Are you living paycheck to paycheck? Or are you creating a surplus that you can invest and put to work? Analyzing your cash flow will really help you identify those leaks, those unnecessary expenses that are draining your wealth potential. And finally, your debt to investment ratio. So this is basically looking at, is your money working for you, or are you working to pay off all that debt? High interest debt can be a major roadblock when it comes to building wealth. So Dr. Gupta offers some strategies for tackling that debt strategically, but also building a strong investment portfolio at the same time. Now let's talk about some of the pitfalls that can trap even those really successful professionals, especially in midlife. Dr. Gupta highlights 3 of these.
Lifestyle inflation, over-reliance on a single income source, usually your salary, and missed tax advantages. And the good news is he also offers some clear ways to avoid them. So first, lifestyle inflation. It's so easy to fall into this trap. You get a raise, you start spending more, and before you know it, you're no better off financially than you were before. One of the key ways to combat this is to automate your savings. Just set up automatic transfers to your investment accounts. That way, a portion of every paycheck gets invested before you even have a chance to spend it. Next up, that over-reliance on salary. So what happens if your job suddenly disappears? What if your whole industry goes through some major disruption? Having multiple income streams is so important for financial security. And Dr. Gupta really emphasizes building both active income, that's from your job or maybe a side hustle, and passive income. So think about things like investments, rental properties, maybe an online business. The more diversified your income is, the less vulnerable you'll be to those economic shocks. And finally, those missed tax advantages.
Are you really taking full advantage of your 401k, your IRA, your HSA? These are all tax-advantaged accounts that can really give your wealth-building efforts a serious boost. It's like getting a bonus from the government, just for saving for your future. Dr. Gupta breaks down all of these accounts, how they work and how to use them to your advantage. Now let's dive into what Dr. Gupta calls the science of wealth building. So we're talking about the strategies, the principles that can help you really accelerate your wealth growth, even if you're starting a little later than you'd hoped. One of the most powerful things in wealth building is this idea of compounding. It's like a snowball effect for your money. And of course, the earlier you start investing, the more time that compounding has to work its magic. But even if you're starting in midlife, it can still have a huge impact on your long-term wealth. And Dr. Gupta gives all kinds of examples, calculations to really illustrate how powerful this can be, showing how even small, consistent investments can grow into significant wealth over time. But compounding isn't just about time,
It's also about strategy.
You got to understand how risk and reward work together. Generally speaking, the higher the risk, the higher the potential reward, but also the greater the chance of losing money. And then on the flip side, lower risk investments, they offer more stability, but the potential returns are lower. Finding the right balance for your risk tolerance and your time horizon is super important. And that brings us to portfolio diversification. You've probably heard the saying, don't put all your eggs in one basket. Well, that's basically what diversification is all about. It's about spreading your risk. So instead of investing everything in, say, one single stock or one asset class or one industry even, you spread it out. You invest in a variety of different assets. And that helps to protect your wealth from those market ups and downs. And it ensures that, even if one investment doesn't do so well, the others can pick up the slack. Now, it's important to remember that building wealth isn't just about your job. In fact, relying solely on your job for income can be pretty risky. As we talked about earlier, Dr. Gupta emphasizes the importance of creating multiple streams of income. Don't just rely on that single paycheck.
He breaks down income into three main categories: active income, portfolio income, and passive income. Active income, that's what you earn from your job or any work that you do, for pay. It's the most common type of income, but it's also the most time dependent. You only earn when you're actually working. Then there's portfolio income. This is what you earn from your investments, things like dividends from stocks, interest from bonds, and capital gains. The great thing about portfolio income is that it can grow passively. You don't have to trade your time for money. And finally, passive income. This is money that works for you 24/7, even while you sleep. It's income generated from assets or businesses that don't require a lot of effort to maintain. Think rental properties, online businesses, royalties from maybe a book or music, even automated consulting services. Passive income is kind of the holy grail of financial freedom. And Dr. Gupta provides strategies for building all three types of income. And he really emphasizes how important it is to diversify those sources for, true financial security.
Now, even if you have a well-diversified portfolio, multiple income streams, market storms are just inevitable. The economy goes through cycles, prices go up and down, unexpected events happen. But understanding how markets work and learning to manage risk can really help you protect your wealth when things get a bit turbulent. One of the keys is understanding those market cycles. Markets tend to go through these periods of expansion, we call those bull markets, followed by periods of contraction or bear markets. And knowing where we are in a given cycle can help you adjust your investment strategy accordingly. So, for example, during a bull market, when prices are rising, you might be more aggressive with your investments. But during a bear market, when prices are falling, it might be time to shift to a more defensive strategy. Focus on preserving capital and minimizing those losses. But, of course, trying to time the market perfectly is really, really difficult, and even the most experienced investors get it wrong. Dr. Gupta emphasizes that long-term thinking is so important. Don't let those short-term market fluctuations throw you off course.
And another important aspect of managing risk is mastering your emotions. When markets are volatile, it's easy to let fear and greed take over. Fear can lead to panic selling. You lock in losses that you could have recovered if you just stayed the course. And greed. Well, that can lead to chasing those hot investments. You end up buying at the top of the market right before things take a downturn. Dr. Gupta gives some strategies for keeping your emotions in check so you can make those rational decisions even when the market feels like a roller coaster. And speaking of risk management, he also dives into this concept of building what he calls an all-weather portfolio. So this is a portfolio that can withstand all those different economic conditions. So it involves diversifying across different asset classes, ones that behave differently depending on what's happening in the market. For instance, during times of high inflation, things like real estate and commodities, they tend to do well, while bonds might struggle. And during a recession, high-quality bonds can provide some stability, while stocks might experience some pretty significant declines.
So by building a portfolio that's balanced across different asset classes, you can minimize that impact of market volatility. So no matter what's happening in the economy, your wealth is protected. Now, as we move into the next part of our deep dive, we're going to explore how to apply these principles to different areas of your financial life, starting with retirement planning. But before we do, I want to leave you with this. Midlife is not too late to build wealth. In fact, it might be the perfect time to really accelerate your journey to financial freedom. You've got the experience, you've got the knowledge, and the earning potential to make serious progress. So the key is shifting your mindset. Embrace that abundance mentality and start taking strategic action to turn those dreams into reality. Okay, so let's talk about retirement planning, something that's probably on everyone's mind, especially as we get into midlife. But before we start picturing ourselves, on a beach somewhere sipping margaritas, let's rethink what retirement actually means.
For a lot of successful professionals, it's not just about stopping work. It's about that financial independence. It's about having the freedom to choose how you spend your time. Whether that's traveling, pursuing passions, spending time with family, or even continuing to work, but on your own terms. And to achieve that kind of freedom, well, you need to start planning early and develop a strategy that aligns with your goals and your income needs. Dr. Gupta outlines a few different retirement models, each with its pros and cons. First, there's that classic financial independence retire early movement, FIRE. This one's all about aggressive saving and investing, trying to achieve financial independence as early as possible, maybe in your 40s or 50s. It requires a high savings rate and a willingness to live pretty frugally, but the reward is that freedom to retire from traditional work decades earlier than most people. Then you have coasting FIRE, which is a bit more relaxed. The goal here isn't necessarily to retire super early, but to reach a point where your investment growth alone can cover your future needs. So you might keep working, maybe with a reduced workload or in a more fulfilling role. Another option is phased retirement, so you gradually reduce your work hours over time.
Kind of easing into retirement slowly. This lets you transition into that new lifestyle while still bringing in some income. And then for those who are more adventurous, there's mini retirements. So this is taking those extended career breaks throughout your life, rather than waiting till, your 60s or 70s. Work intensely for a few years, save aggressively, then take a year off, travel the world, pursue a passion project, whatever you want. So retirement isn't one size fits all. It's really about finding a model that aligns with your goals, your values, your lifestyle. Now, before you start planning those retirement adventures, it's important to assess where you are right now. See how much progress you've made towards those retirement goals. Dr. Gupta has a really helpful table in the book that lays out some key metrics for evaluating your retirement readiness. First, how much have you actually saved for retirement? The ideal target is to have 10 to 15 times your annual income saved by the time you hit 60. Next, do you have any passive income streams? If so, how much of your projected living expenses in retirement can they cover?
Ideally, you want that passive income to cover at least 30 to 50% of those expenses. Then there's debt. Ideally, you want to be debt-free or have very minimal high-interest debt by the time you retire. And have you thought about healthcare costs? Long-term care expenses? These can be pretty significant in retirement, so make sure you have the right insurance coverage or savings set aside. And finally, what are your projected annual expenses going to be in retirement? A good starting point is to assume you'll need about 60 to 80% of your pre-retirement income. Okay, so this assessment is going to give you a clear picture of where you stand and help you identify those areas where you might need to tweak things. Now, let's talk about building a retirement portfolio that can really stand the test of time, one that can generate consistent returns and sustain your wealth for decades. The key here is diversification. You need a mix of assets that behave differently under different market conditions. Dr. Gupta recommends 3 main types of assets: growth assets, income-producing assets, and liquidity.
Growth assets, things like stocks and real estate, are designed to outpace inflation and provide that long-term capital appreciation. Income-producing assets, those are things like dividend-paying stocks, bonds, maybe annuities. They generate a steady stream of income to supplement your savings. And liquidity, which is usually cash reserves, provides that cushion for emergencies and gives you quick access to funds when you need them. Now, the exact allocation will depend on your age, risk tolerance, and those retirement goals. So in your 40s and 50s, you might have a higher allocation to those growth assets. You've got more time to recover from potential market downturns. But as you get closer to retirement, you want to gradually shift to a more balanced portfolio that prioritizes income and stability. But diversification alone isn't enough. You also need to think about passive income. Remember, that's money that works for you 24/7, even after you've stopped working that traditional job. Dr. Gupta highlights several passive income sources that can be particularly beneficial in retirement. Dividend stocks, REITs, they can provide a steady stream of income without you having to sell your assets.
Rental properties can generate consistent cash flow and act as a hedge against inflation. Annuities can give you those guaranteed lifetime payments, which provides a sense of security, especially if you're worried about, outliving your savings. And for the entrepreneurial-minded, things like online businesses, royalty income from books or music, even those automated consulting services can provide ongoing income with minimal effort. The key is to develop multiple passive income streams. Don't rely on just one. That way you've got a diversified income portfolio that can support your lifestyle, even if one stream takes a dip. Now, one of the biggest fears people have about retirement is running out of money. They wants to outlive their savings. But with a well-planned withdrawal strategy, you can make that portfolio last for decades and minimize the risk of, depleting it too soon. Dr. Gupta discusses several popular withdrawal strategies. One well-known approach is the 4% rule. So you withdraw 4% of your retirement portfolio each year. and this is designed to provide sustainable income for a 30-year retirement.
Assuming a diversified portfolio and a reasonable rate of return, of course. Another option is the bucket strategy. Divide your retirement assets into 3 buckets. One for short-term expenses, one for midterm needs, and one for long-term growth. This approach helps you manage that market risk and make sure you have funds available for different time horizons. If you've built up significant passive income streams, you might just live off that investment-generated cash flow. That way, you're preserving your principal, allowing it to keep growing. And don't forget those required minimum distributions, or RMDs. These are mandatory withdrawals from certain retirement accounts, like traditional IRAs and 401ks once you reach a certain age. Understanding these rules is crucial for, tax-optimized retirement planning. The important thing is to choose a withdrawal strategy that fits your situation, your risk tolerance, and your retirement goals. And let's not forget about healthcare costs. They can be one of the biggest expenses in retirement. So first, if you're eligible, contribute as much as you can to a health savings account, or HSA. It's the most tax-advantaged way to save for those medical expenses.
Then understand how Medicare and supplemental insurance work. Look into those different coverage options to avoid any surprises. And plan for potential long-term care costs. Nursing home care can be incredibly expensive. Plan ahead, explore long-term care insurance, or develop those asset protection strategies. Healthcare costs can really impact your retirement savings, so don't ignore this part of your planning. Okay, let's summarize your retirement readiness action plan. First, maximize those retirement contributions. Put in as much as you can to your 401k, IRA, and HSA every year. Diversify your income. Build those passive income sources like dividend stocks, rentals, online businesses. Develop a tax-efficient withdrawal plan. Explore Roth conversions, RMD planning, and tax harvesting strategies to, minimize your tax burden in retirement. Combat lifestyle inflation. The lower your cost of living, the longer your wealth will last. And make sure you have the right health care and long-term care coverage. You don't want those unexpected costs to deplete your savings. Remember, retirement isn't about age. It's about reaching that financial independence. It's about living life on your terms. Now let's explore some specific investment strategies that can provide long-term stability and growth, even when the market gets a little bumpy. Investing in midlife is all about finding that sweet spot between growth, security, and preserving your wealth. It's different than when you were younger. Back then you might have been more comfortable with those high-risk, high-reward investments. You have more time to recover. But as you get into midlife, your priorities shift. You want to see your wealth grow, but you also want to protect what you've already built. Smart investing at this stage requires a few key elements. First, a diversified approach with a mix of growth assets, income-generating assets, and stability assets. Second, you need those risk management strategies to protect against market volatility. Third, a tax-efficient approach to maximize your after-tax returns. And finally, focus on generating that passive income. Supplement your active earnings and really accelerate that wealth-building journey. So in this section, we're going to explore some of the best investment strategies for long-term stability, making sure your money is working hard for you. And it all starts with diversification.
Don't put all your eggs in one basket. Diversification minimizes risk and maximizes returns. A well-structured portfolio has a mix of different asset classes, each with its own risk profile and potential for returns. This helps you weather those market storms, because when one asset class is down, another might be up. So let's break down those asset classes. First, stocks or equities. They represent ownership in a company and offer the potential for high growth over the long term. But they also come with higher risk. The stock market can be volatile. Then we have bonds or fixed income assets, essentially loans you make to a company or government. They pay you a fixed interest rate. Bonds are generally considered less risky than stocks, but they also offer lower returns. Next, real estate. A tangible asset that can provide passive income through rent. Real estate can be a great hedge against inflation, but it can also be illiquid, hard to sell quickly. Then you have commodities, things like gold, silver, oil, raw materials traded on global markets. They can act as an inflation hedge or safe haven during economic uncertainty, but the prices can be volatile.
Then there's the exciting world of cryptocurrency and alternative investments, which offer potential for high growth but also carry significant risk. And finally, REITs, real estate investment trusts, companies that own, operate, or finance income-producing real estate. REITs are traded on stock exchanges, so they're more liquid than owning physical real estate. The key takeaway: a well-diversified portfolio helps to mitigate losses while ensuring consistent returns over time. Now let's zoom in on stock market strategies, especially for those in midlife. Stocks should still be a core part of your portfolio, but the focus should shift from speculative growth to more consistent, stable returns. You're not looking for risky moonshots anymore. So what are some good strategies for long-term stability? First, consider index funds and ETFs. These are low-cost, diversified funds that track a specific market index, like the S&P 500. They're a great way to get broad market exposure. For example, an S&P 500 index fund will hold shares in all 500 companies in that index. Instant diversification. ETFs work similarly, but they're traded like individual stocks. Then there are dividend stocks. These companies pay a regular dividend to their shareholders. It's like getting a paycheck from your investments. Dividend-paying companies tend to be more established and financially stable, so you're generating income from your stocks while you hold them. You can also explore blue-chip stocks. Large, well-established companies with a proven track record. Think Coca-Cola, Johnson & Johnson, Procter & Gamble. And if you're willing to do some research, you can try value investing, buying high-quality stocks that are undervalued. The idea is to buy low and sell high, but it takes patience. Remember Mark, he shifted 30% of his portfolio into dividend-paying stocks. Within 5 years, he had an income stream of $30,000 per year. This let him semi-retire early while his investments kept growing. That's the power of dividend investing. Now let's talk about real estate. It offers cash flow, tax advantages, and the potential for appreciation. First, rental properties. They can provide consistent monthly income, and the property value can appreciate. Then there are REITs, a way to invest in real estate passively through the stock market. You can also consider short-term rentals, like Airbnb. Higher returns than traditional rentals, but more hands-on management. And there's real estate crowdfunding, investing in large commercial projects with smaller amounts of capital. Each type of real estate investment has its own pros and cons. But overall, real estate offers a great combination of income and inflation protection. Now, what about alternative investments? Should you consider adding them? While stocks and real estate are the cornerstones of wealth building, alternative investments can potentially boost returns and provide additional diversification. Things like private equity, venture capital, hedge funds, commodities, and even collectibles. But remember, alternative investments should complement, not replace, your core portfolio. They typically carry higher risk, so proceed with caution and do your research. As your wealth grows, protecting it becomes just as important as growing it. So how do you minimize risk? Diversification is number one. Spread your investments across asset classes, industries, and geographies. You can also use stop-loss strategies, setting a price at which you'll automatically sell if it drops below that level. Rebalance your portfolio annually. Adjust your asset allocation based on your goals, risk tolerance, and market changes. Maintain a cash reserve. This provides liquidity for emergencies. And don't overlook insurance and estate planning. These tools protect your wealth from unexpected events. John rebalanced his portfolio before a major market downturn. By shifting 20% into defensive assets, he minimized his losses when the market crashed and then reinvested at those lower prices when the market recovered. So remember, diversify. Invest in stocks with a focus on stable growth. Use real estate. Consider alternative investments carefully. Manage your risk and have a cash reserve. Investing in midlife is all about balancing risk, growth, and income, making informed decisions and creating the strategy that can weather any storm. Now let's shift our focus to a crucial aspect of wealth building, the psychology of money. It's true, building wealth isn't just about earning more, saving better, or making smarter investments. It's also about how you think about money. A lot of midlife professionals have the means to grow their wealth, but their mindset holds them back. Maybe a fear of risk, guilt around wealth, or outdated beliefs about money. These negative mindsets can limit your potential. So in this section, we're going to explore those psychological barriers, how to shift from scarcity to a wealth-building mindset, how to manage your emotions, and develop a more abundant approach to money. It starts with understanding your money beliefs. These beliefs are often formed in childhood, shaped by our early experiences, but they might not be serving you well now. Let's look at some common limiting beliefs. One is, money is hard to earn. This can lead to risk aversion and underinvesting. The shift here is to understand that wealth is built through smart strategies, not just hard work alone. Another is, rich people are greedy. This creates resistance to wealth. The shift is to understand that wealth can be used for positive impact. Then there's, I don't deserve wealth. This often comes from low self-esteem. The shift is to understand that you are worthy of abundance. And finally, more money means more problems. This leads to a fear of scaling income. The shift is to realize that money, managed wisely, can enable choices and reduce stress. Your beliefs shape your decisions. Reprogramming those limiting beliefs is essential. Now, let's break free from that scarcity mindset. Scarcity thinking is all about lack, limitation, and fear. It can lead to fear-based financial decisions, avoiding opportunities, and underpricing your skills. So how do you shift to an abundance mindset? Change your perspective. See money as a tool. Focus on what it can enable. Surround yourself with wealth-positive influences. Prioritize value over cost. Reframe risk as a necessary component of growth. Lisa, who was earning a great salary but felt financially stuck, is a great example. Once she embraced abundance, she started investing, negotiated a higher salary, and launched a consulting business. Within 5 years, she doubled her net worth. A growth mindset leads to better outcomes. Now, how to manage emotions that cloud our judgment. We all make impulsive purchases, sell investments out of fear, or miss opportunities. Successful people learn to master those emotions. So, what are some traps to watch out for? Fear of loss. This can lead to hoarding cash or selling at the wrong time. Focus on long-term growth and remember that fluctuations are normal. Impulse spending. Those unplanned purchases add up. Implement a 24-hour rule before major purchases. Overconfidence. This can lead to excessive risks. Rebalance your investments, seek advice, and challenge your assumptions. Regret avoidance. This leads to analysis paralysis. Break down big decisions into smaller steps. And remember that no decision is irreversible. Mastering emotional control leads to long-term stability. Now think of wealth as a tool for freedom, not just accumulation. What's the point of a big nest egg if you're not using it? True financial success is about creating options and living a fulfilling life. So how do you align your wealth with your purpose? Define your financial freedom goal. Use your money for experiences, not just possessions, and create a wealth impact plan. Think about how your money can serve your family and community. Money without direction often leads to stress. But when you have a purpose for your wealth, it creates fulfillment. Now, some practical habits to strengthen that wealth-building mindset. Review your net worth and goals weekly. Read books and listen to podcasts on finance. Surround yourself with financially successful people. Invest in skills that increase your earning potential. And celebrate those small wins. Wealth is about mindset and numbers. Replace those limiting beliefs with strategic thinking. Financial independence is about using your money effectively. Smart investors focus on growth, security, and positive impact. So, ready for a midlife financial makeover? Let's reset and restructure your foundation. By midlife, your financial decisions have compounded. Some feel secure, others feel stuck. But it's never too late to change. A midlife financial makeover is about optimizing your situation, eliminating those inefficiencies, and creating a clear plan for security and growth. We'll walk you through a structured approach. It starts with a financial checkup. Dr. Gupta provides a financial health check table. It breaks down your finances into key categories. What's your savings rate? Is it 15 to 25% of your income? How about your net worth? Growing by at least 8 to 10% each year? Debt to income ratio. Mortgage debt below 35%. Other debts under 10%. Investment allocation. At least 50% in growth assets. Emergency fund. 6 to 12 months of living expenses. If you can check yes to most of these, you're in a strong position. But if not, don't worry. The following steps will help you improve. Reassess your financial health annually. Now let's fix those financial leaks. What are some common leaks? Monthly subscriptions. Take a close look and cancel anything you don't use. High interest debt. Prioritize eliminating it. Tax efficient investing. Maximize contributions to your 401k, Roth IRA, and HSA. Don't underestimate your income potential, and don't neglect your investments. Every dollar you save is a dollar that can work for you. Now let's accelerate your wealth building with an investment upgrade. Reallocating your capital towards higher yield opportunities. What does an upgrade look like? It might involve increasing your exposure to the stock market. It could mean shifting some savings into dividend stocks and bonds for income. Expanding your real estate portfolio. You might even consider diversifying to alternative investments like REITs, private equity, or even startups. And always maximize those contributions to those tax-advantaged accounts. Remember, investing in things that appreciate is key to making that wealth compound efficiently. Okay, now let's talk about building a long-term cash flow system. This is so important for achieving true financial independence. You know, where your investments, your income streams, can fully replace or at least supplement your earned income. What does this ideal cash flow system look like, especially in midlife? Well, it means having enough passive income to cover those fixed expenses. So your investments, your rentals, those dividend stocks, your online businesses, they're generating enough cash flow to pay your bills without needing that traditional paycheck. It means, having less financial stress from employment, so you have that option to work because you want to, not because you have to. It also means having a tax-efficient withdrawal strategy, so when you do start using your retirement savings, you get to keep more of that money. And ideally, it means being debt-free or having very little debt, which frees up more cash flow to invest and grow that wealth. Remember, having multiple income streams provides security no matter what's happening in the job market or, the economy as a whole. Now let's create a 3-year financial acceleration plan. Having a timeline like this can help you kind of break down those goals into smaller steps and make sure you're actually making progress.
So in the first 6 months, really focus on getting rid of high interest debt, optimizing your tax strategy, and cutting those financial inefficiencies. That'll free up more money to invest. Then from month 6 to 12,
Ramp up those investment contributions and make sure your portfolio is allocated in a way that makes sense for you and your goals. Year 2, it's all about expanding that real estate or dividend portfolio and creating more income streams to accelerate that passive income growth. And in year 3, take a step back. Look at how far you've come and see if you need to adjust your strategies to make sure you're on track to hit those goals. Think of your finances like a business. Track your performance and use those numbers to make adjustments. Finally, let's set some long-term financial goals for the next decade. What do you want to accomplish? First, sustain that passive income, even beyond retirement. You want to make sure that money keeps flowing. You also want to think about your financial legacy. So that's estate planning, charitable giving, making sure your wealth has a positive impact. Tax efficiency is crucial too. You want to protect your wealth from unnecessary taxes.
And of course, you want to make sure you've got those healthcare and lifestyle needs covered. So ask yourself, are you really on track for long-term success? Is your net worth increasing by, at least 8 to 10% every year? Are you building those passive income sources? Are you managing your debt wisely? Are your investments optimized? And do you have a clear financial roadmap for the next 10 years? Remember, the faster you restructure your finances, the sooner you can achieve true financial independence and live life on your terms. Now let's talk about building a legacy, one that goes beyond just your lifetime. This is something a lot of successful people forget about until it's too late. True financial success isn't just about accumulating wealth for yourself. It's about using that wealth to make a lasting impact on your family, your community, future generations. Legacy planning isn't just about leaving an inheritance. It's about making sure your loved ones are financially secure, making that wealth transfer as smooth as possible. And maybe most importantly, passing down knowledge and wisdom, not just money.
A lot of people focus on building wealth, but then they haven't planned for what happens to it after they're gone. So how do we design a legacy that lasts? Well, we start by shifting from personal wealth to multi-generational wealth. There's this pattern. The first generation makes some money, the second generation keeps it, but by the third generation, it's gone. Why? Because no one taught them about money. They didn't plan, and their lifestyles got too expensive. We want to break that cycle, build a legacy that lasts. And that means having a strategy to make sure your wealth isn't just transferred, but protected and used well. What are some of the key strategies? Well, first, everyone needs a will. It's a legal document that says how your assets should be divided when you die. If you have a lot of assets, a living trust is a good idea. It avoids probate, which is the legal process of dividing things up, and makes things more organized. A power of attorney is important too. This lets you choose someone to make financial decisions for you if you can't. A healthcare directive outlines your medical wishes. And for those who want to give back, charitable trusts and donor-advised funds can help structure those donations.
Estate planning isn't just for rich people. It's important for anyone who wants to protect their assets. Okay, now let's talk about transferring wealth in a tax-efficient way. Without planning, a big chunk of your money could be lost to taxes. So how do we minimize the tax burden on your heirs? First, use the annual gift tax exclusion. You can give up to $17,000 to each person every year without any gift tax. Second, think about setting up trusts for your beneficiaries. They can help distribute assets and protect them from creditors. Third, look into Roth IRA conversions. Withdrawals from Roth IRAs are tax-free for your heirs, and they don't have those required minimum distributions. Charitable giving can reduce the size of your taxable estate too. And don't forget insurance. Life insurance can help cover estate taxes. Mark, a business owner, is a great example. He used trusts, life insurance, and gifting strategies to cut his estate taxes and make sure his wealth went to his family smoothly. With the right planning, you can make that transfer efficient and minimize the taxes your loved ones have to pay. Now let's talk about building a legacy that's about more than just money. What impact do you want to have?
You could start a family foundation to support your favorite charities. You could fund scholarships. You could invest in companies doing good things. You could teach the next generation about business. When you give back, your legacy reaches beyond just your family. And finally, let's talk about teaching the next generation about money. This is so important, but people often forget about it. So, how do we prepare our heirs to handle wealth? Start early. Teach your kids about budgeting, investing, and being financially independent. Don't just hand over a bunch of money when they're older. Use trust to make things more structured. Encourage them to build their own careers. They shouldn't just rely on inheritance. And be open about your plans. Talking about it can prevent problems later. Lita inherited millions but had no financial education. She made bad investments, spent too much, and didn't know about taxes. She lost most of it. If she had been taught about money, she could have kept it. Teaching financial responsibility is just as important as leaving money. Okay, so to recap, make sure you have a will and an estate plan. Use trusts and strategies to minimize taxes. Give back to your community. Teach your family about money. And if you have a business, have a plan for who takes over. Remember, true wealth should outlive you. It's not just about living off your money. It's about making a difference for future generations. Now let's talk about designing a financial lifestyle that's built to last. True financial security isn't just about reaching some magic number for retirement. It's about building a lifestyle that gives you long-term wealth, flexibility, and confidence no matter what happens. A future-proof financial lifestyle means your income doesn't come from just one place. It means you can handle economic downturns. It means paying as little in taxes as possible. And it means having investments that keep growing. So how do we make that happen? We start by making sure your income comes from multiple sources, not just one paycheck or one investment. Think about it. Active income from your job or freelance work, passive income from dividends or rentals, and income from your investments growing. Aim to have at least half of your future income come from passive sources or investments. That'll give you the stability and flexibility you need. Now, let's talk about taxes again.
Taxes can take a big bite out of your wealth, but you can keep more of it with some planning. Remember those tax-advantaged accounts, 401k, Roth IRA, HSA. Max those out. Roth conversions are a good idea, too. You can move money from a traditional IRA to a Roth IRA and take it out tax-free in retirement. Learn about harvesting capital gains. Sell investments that have gone up in value when taxes are low. And remember, tax efficiency is important in estate planning, too. Remember Mark, who used a Roth conversion and saved himself over $150,000 in taxes. That's the power of planning. The less you pay in taxes, the more you keep. Now, what about those unexpected things that happen in life? Job losses, medical bills, market crashes. These things can really mess up your plans, but you can prepare for them. How do we build that financial safety net? Well, first, have a good emergency fund. Aim for 6 to 12 months of living expenses in an account you can access quickly. Next, have some income that doesn't depend on the economy, like from rentals or online businesses. Keep your expenses low and avoid too much debt. This gives you a buffer. And remember diversification. These strategies can help you handle those tough times without derailing your financial goals. Okay, now for the fun part. Designing your ideal lifestyle. Financial freedom isn't just about having money. It's about using it to live a life you love. So what's your dream? Do you want to work or not? Make sure your investments and passive income can cover your costs so you have the choice. Want to live in another country? Think about geo-arbitrage, where you live somewhere cheaper, passionate about giving back. Include charitable giving in your plan. Lisa retired early because of her diversified income. She went from a corporate job to part-time consulting and had rental income in dividend stocks. This gave her the freedom to travel and follow her passions. Remember, financial independence is about having choices. Now let's make sure your wealth is protected and can be passed down. To really future-proof your finances, you need a plan to protect your assets, minimize risks, and keep that wealth growing. Here's what to do. Update your investment strategy. Make sure your passive income is more than your expenses. Optimize your taxes. Have an emergency fund and some recession-proof assets. Make sure your lifestyle and spending habits are aligned with your goals. And have a good estate plan. Financial freedom isn't just about how much money you have. It's about how it's structured. Remember, it's about resilience, not just growth. The right strategies will create long-term flexibility. And it's not just about financial security. It's about a fulfilling lifestyle. Your plan should change as you do. Okay, let's put all this knowledge into action. We've talked about a lot, but how do we actually make it happen? Financial independence is about taking action. You know how to take control, grow your wealth, protect it, plan for retirement, and leave a legacy. So, let's make a plan. First, let's map out the next 12 months. Month 1, do a financial audit. Figure out your net worth, savings rate investments, and debt. Month 2, cut unnecessary spending, automate savings, and start paying down debt. Month 3, boost your income. Month 4, increase investment contributions. Month 5, optimize your taxes. Month 6, diversify your investments. Month 7, start or grow those passive income streams. Month 8, check your risk protection, emergency fund, insurance, estate plan. Month 9, look at your goals and adjust your plan. And months 10 through 12, keep refining those strategies. It's a process. Now let's make sure your wealth plan is future-proof. Things change, so your plan should too. Review and adjust it every year. Stay informed about what's happening in the economy. Keep building income and finding investments. Make sure your estate plan is up to date. And be smart about risk. It's a journey. Okay, let's set some milestones to track your progress. Everyone's goals are different, but milestones keep you motivated. Ask yourself, does your passive income cover half your expenses? Is your portfolio growing? Are you managing debt? Do you have a safety net? Do you have a tax strategy? Can you work if you want to or not? If you can say yes to most of these, you're doing great.
It's not just about how much you have, it's about having the right systems in place. And finally, the right mindset is key. Here's how to think about it. See money as a tool. Think long term. Understand compounding. Control your emotions. And keep learning. Financial freedom is a lifetime commitment. So ready to create your roadmap. Here's what to do. Maximize your income.
Invest aggressively, but be smart about it. Build multiple income streams. Rebalance your portfolio. Have a good estate plan. Spend mindfully. Invest more. And never stop learning. You're in control. Start today. This deep dive into U 2.0 has given you the tools to rewrite your financial future. It's about realizing your potential and taking action. So go out there, embrace those opportunities, and build the life you've always wanted.